Kindly note that the views and opinions shared in this video are those of the speaker and do not constitute advice given by Classic Private Wealth. Any advice given by Classic Private Wealth will be in writing in the form of a wealth management proposal. Classic Private Wealth is an authorized financial services provider.
So the first point is kicking off with what's new. There's obviously lots of new in the sense that in 2 days' time in South Africa, we are going down one stage, meaning we go from stage 5 to stage 4 in terms of the lockdown. So this is actually not an unusual feature for South Africa. So what you're seeing around the world is that the epidemics are coming under control. So in a place like China, they are now reporting the fact that they no longer have new infections. From a place like New Zealand, they're saying they think they can actually eradicate the virus totally on the New Zealand island. In a place like New York, they're saying we're actually seeing some capacity in our hospitals. In a place like Italy, they're saying we're thinking of going towards some kind of opening. In Germany, they're saying we are announcing some opening of the economy happening roughly mid-May or in May. So around the world, we're seeing a lot of thought about what is the next stage. How do you handle the next stage of the lockdown, and how do you bring your economy back? At the same time, you're also seeing further announcements of relief measures. So what we saw in South Africa in the last week is we saw a 500 billion rand relief measure package. That's about 10% of GDP. That's about as much as you can afford in South Africa. But the real question in South Africa is how do we get that 500 billion to the most vulnerable people? Because the other thing that you're seeing around South Africa is if you read the newspaper, roughly the first 4 or 5 lines is just about protest here, protest there, riot there, looting there. So you're seeing that the hungry population that has been locked down are starting to come out and are not very happy, so they need help desperately in South Africa. So let's maybe talk about what a next stage of lockdown looks like. And the first thing is that the most common thing that most people who think about the second stage of lockdown talk about is testing. You've got to be able to test very accurately, and you need to be able to run a lot of tests and get fast answers. Otherwise, you can't actually lift your lockdowns. So any lifting of lockdown should normally be accompanied by the ability to do a lot more testing. So around the world, people have been trying to ramp up their ability to test. In a lot of places in the US, they still don't have enough testing, but they're going ahead with some opening up of the economy. I think a lot of that is politically motivated rather than rational health policy. But in principle, if you could know who is ill, then you could actually return to normal much more quickly. So what you would have is you would have people on site, but as you come on site at your job, they will test you as to whether you're healthy or not. If you're not healthy, they'll send you home and only allow the healthy people to continue working. And then they will have test tracing, so they will actually follow up and trace those people who have had contact with infected people. So testing and tracing is supposed to be a very important part of the next stage of lockdown. So in places like Germany and South Korea and so on, there's still a huge amount of testing and tracing going on in order to keep the situation under control once it has come under control. But the one thing that's ubiquitous is that travel is severely restricted. So in South Africa, for instance, you're not allowed to travel in provinces. So why would you have that? Because the idea of the next stage is that if we have to lock down again because we have recurrences or occurrences of epidemics, you want to lock down only those places that are affected. So if you don't allow people to travel between provinces, you might have the situation where you still have strict lockdown in Gauteng, but you can open up the Northern Cape to a much larger extent. So one of the things that's ubiquitous is travel restrictions, at least between countries. So traveling between countries is extremely difficult at this point, which also means that globally, the tourist industry is still completely shut down, meaning that about between 5 and 10% of GDP can't happen at all because tourism is still shut down. Then the next thing that you have is all mass gatherings of people. So sport with spectators, for instance, will definitely not be allowed because it says a lot of people will gather at the same time. Typically, restaurants will not be allowed to open. There's a lot of debate about schools because one of the things that we're seeing is there's a lot of schooling going on in a virtual way. But if you think about countries like South Africa, not everybody has access to it. And if you're in lower grades of school, there's not a lot that you can do remotely. So you actually have to go to a physical school. And there's a lot of debate about what kind of spread of the virus that would mean. Again, if you were able to do a lot of testing, you could get schools back. But at this point, it looks like schools are not going to be allowed to open. Universities will not be allowed to open physically. So anything where there's a lot of members of the public coming together will not be allowed. The other thing that is very unlikely to be allowed in the first phase or in the second phase of lockdown, if you like, is personal services. So things like hairdressers, barbers, etc. So even doctors, dentists, and so on will only be allowed to do necessary, essential stuff. So the definition of essential will be expanded a bit. The things that are likely to get back to work are the places where either you can isolate your workers, your workforce. So if you were able to run a mine and you could get your workers to live on site, you could make a bubble of that mine. So if you're excluding everybody and trying to keep everybody inside healthy, that's called the bubble. So you could make a bubble of a country like New Zealand, or you could make a bubble of a mine where you have all your workers staying on site and getting back to production. And even factories where you don't deal with the public and where you can have distancing, where you can distance workers from each other, those things are likely to come back. But we're likely to still see roughly 10% of GDP lost. So we'll go on to a next stage. And what you would like to think is, you would like to think that it is a intelligent lockdown, meaning I live on a golf estate, but I'm not allowed to walk on the golf course. And it's very unlikely that if I walk on the golf course that I'll contract the virus, especially if everybody else on the golf course are wearing cloth masks. But I know that the golf course has to be shut because there's so many people who wouldn't use that privilege intelligently. So in countries like Sweden and Holland, they say we trust our people. They're adults. They will act in an adult way. They will, we can allow them to do what they think is right. But that's not really something that's possible in South Africa. So let me actually deal with this in two sections. The one is the world. And in the world, we're likely to see a strong move towards a more intelligent lockdown, which will be much less restrictive, but we will stay in some form of lockdown, and we're likely to see recurring bouts of localized lockdown, meaning if an occurrence happens in a specific city, that city might be locked down, but you wouldn't necessarily lock down the whole country. Tracking and tracing and testing will help to localize the lockdowns. The other thing, of course, is that we've seen a return of politics in the US. meaning there's a massive difference now between the president and the Republicans and the more democratic guys. The president and many of the Republican governors are giving priority to opening up. We think that that will be mostly temporary, because as soon as they have the ambulances driving through the night to bring patients into intensive care, but there's no space in intensive care, they will lock down again. So we don't think that those openings up will last very long, because they'll get a recurrence of the virus and then they'll lock down again. But effectively, there's a lot more political. There was a small period of political consensus about how to deal with the virus. We seem to be past that period, and the election towards the end of the year is starting to take precedence above healthcare issues, and there's very little rational discussion of healthcare going on. It's very politicized from both sides. So that, as far as the world is concerned. So effectively what we think is that the bulk of the developed world will stay in stage 2 of lockdown until we get some form of treatment for the virus, either a vaccine or some kind of medical treatment, and that is likely to happen sometime in the first half of next year. So probably another roughly a year of phase 2 lockdown for the developed world. What we're seeing in the developing world, if we can go to the South African graph, please. So this is a graph you can see every day on News 24. What you see in South Africa is we've had a very strict lockdown. And in that very strict lockdown period, we've seen the following happening. If you look at that graph, the little red graph are the new infections reported daily. We don't really think that that's a very accurate measure, because we're not actually testing enough. But the confirmed cases, you can see that blue line. And you can see that the blue line is turning strongly upwards again. So what you seem to have had is quite a lot of infections being tested, and that seems to have been in the sophisticated part of the population, which came back from skiing holidays in Europe in kind of February, and then there was lockdown, and lockdown seems to have slowed the spread of the virus quite a bit. But then you see that the virus seems to have gotten into the general population, which is much more vulnerable and is really unable to lock down. So one of the things we've seen is that in what you might call the suburbs, lockdown is quite strict. In the townships, lockdown is not so strict, meaning people are moving around, and you have to say that those are vulnerable people who may not be able to stay locked down just because they don't have an income. The whole question of saying, if I stay home, I'll die anyway of hunger, so let me rather die of the virus. So in South Africa, all the evidence at this point is that we're unable to maintain a strict enough lockdown in order to contain the disease. So we seem to be on our way to a much wider spread of the disease. So all the preparations of hospitals and intensive care, etc., that we've seen over the last month or so, that would seem to be necessary. So what you have to say about the government is that they always expected this. They've always been saying that we are not trying to eradicate the virus the way that the New Zealand government is trying to eradicate the virus. That's just not realistic in a South African context. But we are trying to slow it down. So we don't want a peak in June. We want a peak in September. So currently South Africa is projecting the peak in September. But what it means is that in South Africa, we are likely to see a lot more people infected over the next couple of months, and we're really likely to see a severe health crisis. So a lot of people will get ill and a lot of people will die. And I was speaking to someone yesterday, and he was saying the emotional experience of South Africans will change radically over the next 2 months. Because the emotional experience at this point is gee, it's hard to be locked down. And should I be ignoring the lockdown or should I stay locked down? In 2 months' time, people will lock themselves down because they will realize that a lot of people out there are infected and you don't want to catch the infection. So actually, we think that there's a whole new thing coming along of people wanting to stay locked down rather than being forced to stay locked down because the virus are going to spread. And as the one guy said on TV, if you're lying at night and you're listening to the sirens of the ambulances carrying people to intensive care, it's very different from just being locked down. So we think there's a whole new stage coming in South Africa, and it's unfortunately our prediction that South Africa will not be able to lock down strictly seems to be coming true. If we could remove the graph, we don't think we need the graph anymore. So in essence, what we're going to see in South Africa probably is a couple of months of very severe repercussions, actually quite a lot of people dying. And again, in most of these places that you see it spreading widely, you see roughly 80% of deaths in people of 70 or older. So a lot of old people will start dying in South Africa. And this will be across the board. This will be in poor communities and in other communities because there's no isolating communities from each other in South Africa, although what you are likely to see is that the richer part of the population will go into self-isolation in order to isolate themselves from the epidemic ripping through the rest of the country. So it will be worse for poor people. It's unfortunately true that most of these events are always worse for poor people, although this is something that isn't contained in poor people, meaning someone like Boris Johnson can get infected, and Boris Johnson, by all reports, very nearly died. So even the mighty can fall in this stage. Let me make a couple of comments about markets while we're at it. What have we seen in markets? And what we've seen to a very large extent is that a measure of calm has returned to stock markets worldwide. So first of all, markets are still down, but they're not down all that much. They're down somewhere between 10 and 20%, which is actually mild given the economic situation. And also the volatility in stock markets have reduced. So in March, we had a stage where for 2 weeks, we had a move of 7% or more up or down in global stock markets every day. Now we seem to be having movements of about 2% to 3% per day, and not the 5%, 7%, 10% per day that we were used to in March. So just as a comparison, in normal times, any move of more than 1% is considered unusual in one day. So we've had some very unusual times, but actually some kind of calm has returned to markets and markets have stabilized. At the same time, we've seen emerging market currencies come under a great deal of pressure. So the rand is a lot weaker than the rand was before, but so is the Brazilian real and the Turkish lira, and virtually every other emerging market that you can think of has been down-rated. Now, again, part of what we need to ask ourselves is this realistic? Is this a true reflection of the trouble? And the answer in my mind is no. So actually, we think that the emerging market currency issues are much more related to a lack of liquidity brought about by the rapid adjustments in stock markets worldwide. It basically means people run into cash and then there's just not enough cash around. And in the large countries, central banks then come to the rescue. And the Federal Reserve gives a lot of facilities to other developed countries in order to keep to help them to keep their exchange rate stable. But that facility is not available to emerging countries, so emerging currencies all fall quite a bit. We saw something similar in the credit crunch. But then emerging market currencies actually rapidly returned to a more sensible level. The rand tested the 19 rand level. It went over 19 rand to the dollar for a while. It seemed to be under that. We think a realistic level for the rand sits much closer to 15 to 16. We don't think it necessarily goes there rapidly. But the important thing to know is that South Africa and emerging countries don't actually get affected much worse than developed countries. This is a problem across all countries. All countries are roughly equally affected. We do think that the way that emerging markets come out of this, so Brazil, for instance, is having a significant epidemic, is that the virus spreads through the economy. A lot of people die, but they come out of the other side with some form of herd immunity fairly quickly. So by the end of this year, you'll see most emerging markets have already had an epidemic and have some form of herd immunity, whereas developed markets are still in a fairly severe form of lockdown, waiting for a vaccine. So we don't think economically emerging markets gets much worse affected. So we think that's actually a nice opportunity for investment. At the same time, the bond markets in those countries, also the South African bond markets, have reacted strongly, meaning even though short-term interest rates are falling in order to support the economy, long interest rates are rising or have risen quite a lot, which means bond prices have fallen through the floor. So if you look at it, in general, emerging market bonds are about 25% cheaper in dollar terms than they were at the beginning of the crisis. And we don't think more than about 5 to 10% of that is justified. So we think there's an opportunity there. It's not something that we would normally be playing with because it's not really a very safe way to invest in normal times because emerging markets are always risky, but we think this is way overdone. Whereas stock markets seem to have taken the view that this is actually the worst of it is behind us. The economy will start opening up soon. Stock markets and activity will return to where it was before very quickly. And happy days will be with us again. And we just don't think that's correct at all. We think that there are some very severe economic issues. If we listen to the comment of market commentators and fund managers, you very often get this thing of the worst is behind us, the worst thing you can do is to panic, and so on. Also, most advisors of individuals are so steeped in the thing of never panic that they're saying to their clients, just wade through this, sit tight, wait for it to pass, you'll be fine. We don't believe this is true at all. We think that markets are getting this wrong. If you listen to economists, most economists are saying the news we seeing now is worse than expected. Therefore, we actually think that the impact eventually on economies will be worse. And there's lots of discussion about how do governments deal with the huge amount of debt that they are making in the course of this crisis. How do they deal with it afterwards? So the things that they're going back to is the period after the Second World War, when most countries in the world had very high debt levels. How did they cope with that debt levels? How did they work off that debt? And the answer is really that they had some form of financial repression for decades in order to fix their debt problems. So there's all kinds of discussion about what kind of financial repression might we see. Our own view of it is that for developed economies, this is less of a problem for governments than you think, because effectively they can just print the money for the short term because there is no excess demand, meaning printing money doesn't have an inflationary effect in the short run. So the relief measures, the disaster relief, they can fund through just printing the money. And then when they get out on the other side, what they need to do is significant infrastructure investment. So yes, they'll be spending a lot of money increasing their debt, but they'll actually have corresponding assets. So we think there's actually a massive worldwide surge in infrastructure creation from 2022 to 2026, because these things take a while to come along. And we think that in order to deal with the deep recession that we'll find ourselves in when we get out on the other side of this, there will be lots of stimulation needed. We hope that a lot of that investment will go into green energy, because part of what you need in the world is, in order to deal with global warming, you actually need to make a transition to green energy production. And people are normally saying, but where will we get the money and the savings to finance the massive investment that's needed? Well, massive investment is needed to stimulate the economy, let that investment flow into green energy, and you can come out on the other side in a fairly healthy way. So that, interestingly, is actually quite good for South Africa, because the stuff that we would normally export, any infrastructure creation is very intensive in the stuff that we would normally export. So we think that the South African situation is we come out the other side fairly quickly, because it spreads through the economy or through the country very quickly, the virus. We get on the other side with herd immunity. And then as soon as the whole world gets back to recovery, we actually have strong exports of commodities from our mining communities. So not necessarily a terrible scenario for South Africa. But what we do see in the rest of the world is an initial phase of quite a deep recession, followed by very strong stimulatory measures. And the market consequence of this is that initially, as people realize how deep the recession is, markets are likely to go down quite a lot, because profitability will be under severe pressure. And then as the government starts stimulating their economies, there's a gradual recovery that leads to a multi-year bull market from 2022 onwards. So that's roughly where I stand. Shall we have comments and questions?
Oscar.
Wikus, I've had a couple of questions. One, in the USA, could massive quantitative easing, as you suggested, is required, not help create a V, not a W curve?
So massive stimulation will help, and the stimulation that's already in place is helping to make sure that the V is not too deep. But what we believe is that effectively that's still just the relief portion. It's still just the disaster relief portion. What you will need is massive longer-term stimulatory measures. So there's no real reason to think that we can get a V recovery. We think that it's a much more open V. The second leg of the V will be much slower. The down leg will be quick, and the up leg will be slow, just because even though you have these quantitative easing, etc., that will not fix consumer confidence and business confidence in a day. It will take years to fix the kind of confidence that we see. So that's our opinion. The other interesting question we've had is about sport. One of the things that we like to see come back in a second stage is sports where you have very little contact. So you would actually probably see tennis return, but without spectators. But there'll be large TV audiences for tennis, for instance. Even soccer will return. Rugby is a very close contact game. So rugby and wrestling or maybe will take a bit longer to return than soccer and tennis. But things like marathon running, there's every reason to think that the London Marathon will happen with only 10 participants. So the 10 top marathon runners in the world will run the London Marathon, and maybe in a sub 2 hour time. And it will be televised worldwide with great attention. But the hundreds of thousands of people that would normally want to run the London Marathon will sit in front of the TV, or maybe they'll participate by going around the yards. a couple of times. But yeah, so stimulatory measures will be helpful, but we think that the level of stimulatory measures, in order to be equal to the level of downdraft caused by this, needs to be much higher still than it is now.
Thanks, Wikus. The second question is that you mentioned the rand, a massive drop. There's some commentators saying that in the next few months the rand could bounce back, and obviously a lot of people are wanting to move money offshore. What is your feeling about the rand strengthening somewhat anyway in the next sort of 2, 3, 4 months?
Yeah, I think that's more than likely, because what was likely to happen is there will be some dissipation of the liquidity constraints on these emerging market countries. So it's very likely that the rand will go back to a more realistic level of, let's say, 15 to 16 fairly quickly. But then while the world is in lockdown and so on, the rand is likely to stay a little bit weak. But we then see if our exports were to be strong in the 2022 to 2026 level, we might actually see a much stronger rand during that period, because commodity price strength is typically what drives rand strength. So there's no real permanent reason to think the rand will be weak, but 15 to 16 is more realistic. So we wouldn't be buying dollars for our clients at this point, because we really think that the rand is just way too weak. And you either buy the dollars and hedge back, or you wait until the rand is at a stronger level. One of the things that we do expect is we think that stock markets at some point will start to correct, and that might actually renew the pressure, the liquidity pressure. It's likely that in the short run, markets will still be more volatile than normal, and that will include currency markets. But we certainly don't think that the current levels of the rand is a permanent feature.
Thanks, Wikus. The final one is that there has been one of the suppliers that we have been recommending and using has had a remarkable success in terms of the ability to reduce the downside. And from my knowledge of it, it has a structure in which it has automatically reduced the equity portion of the fund, and as a result, the downside of that particular fund, which is called Dynamic Parity, has been far lower than the average of other asset managers. Without giving too much of a plug, there are methods of reducing this downside, and as I say, from a strategic point of view, this fund has automatically, using its system, got out of a lot of the equities in it, and are sitting with cash ready to maximize the upturn in equities when they happen.
Yeah, I think that if we can talk about our clients have actually gone through this with very little upset, if you like, in the sense that, first of all, the first thing that you would do in order to handle events like these is to have proper planning in place. So all of our clients are sitting on enough cash to carry them through the next 6 years. So even if this takes 6 years to dissipate, our clients would be fine anyway. So that was point number one. Point number two is that we invested our clients, and a lot of them through the Dynamic Parity Fund, into, first of all, a multi-asset approach, which means that some of the assets are actually geared to do well in difficult times. So the gold and the government bonds and so on in those portfolios have done well and weathered the storm. The other is that they've had this automatic reduction of exposure in times of high volatility. So our clients have been absolutely fine, and our clients will stay fine if there's more of an issue. We actually think that our clients will do really well, because our clients will have lots of cash on hand when we get to the bottom of this market. So we think the bottom of this market is still somewhere between 3 and 9 months away. And when we get there, we think that we will be able to buy very cheap stuff for our clients. So we think our clients will actually benefit significantly from this whole event rather than being negatively affected. And at the same time, they've never really had reason to be extremely upset. Our clients have been able to sleep well throughout the crisis because they've been structured for a surprise of this nature anyway, because the basic departure point that we have is the future will surprise you, and therefore be ready for a surprise. And we've really seen that work in this instance.
Thanks, Wikus. I think Keith has come on board. Has he got a question?
Wikus, just very broadly, where do you see interest rates going over the next 3, 6, 12 months?
South African interest rates.
Yeah.
I can make a very confident prediction about the interest rate in developed countries, in the hard currencies. Interest rates for the next 5 years will be somewhere between -1 and 0. So there you have a very confident prediction. Very easy to say what will happen in dollars or euros. Interest rates will stay extremely low. In South Africa, we expect the official rate to come down a bit more, but in order to have to support the currency, the government will, or the central bank will want to retain some yield in the rand. So what would attract people into the rand? The rand will have a much higher yield than hard currencies. But to some extent, the authorities are helped by the fact that long rates are very high because of the, and this is around the world in emerging markets, but in South Africa as well. You can earn 13 or 14% on South African government bonds. So there's a high yield on the bonds anyway, so that will attract money into South Africa, so you can actually afford to lower the rates at the short end. So we think that this whole incident means that there will be very little inflationary pressure, and there will be enough room for the South African Reserve Bank to keep bringing rates lower. So we think rates go down another 100 to 200 points.
Thanks, Keith. Are there any other questions? If not, thank you so much, and particularly for the guys that have checked in for the first time.